In the world of finance, there are certain terms that get thrown around frequently, and often people within the industry just assume that everyone knows what they mean. In fact, sometimes people even assume that they themselves understand what it means, but when they actually stop and think about it, they really don't know at all. One of these terms is the infamous hedge fund. These types of companies gained a bit of notoriety thanks to their perceived involvement in some of the darkest days in the financial markets and with specific assets. But although we're all familiar with the term hedge fund, it seems not everyone is familiar with what it actually means. So in this video, I'm going to be giving you a basic overview of hedge funds, including their history, how they've evolved, some of the key attributes of them, their strategies, and their role in the financial markets. This will allow you to make more sense of when this term is used in the financial media, and hopefully allows you to differentiate between other types of investment firm. The birth of the hedge fund can be attributed to Alfred Winslow Jones, who in 1949 took long positions of undervalued securities and short positions of overvalued securities as an insurance against the downturn in the market, thus creating a hedge fund as he was hedging the position. However, according to Warren Buffett, the roots of the concept dates back to the mid-1920s. Benjamin Graham, who is widely known as the father of value investing, used the same strategy to hedge his investments and also to charge an incentive fee to investors. The strategy was to generate returns irrespective of the market's direction. Hence, the name of the funds comes from the strategy itself. The authorities have yet to assign the hedge fund a legal definition. Essentially, many regard hedge funds as an alternative investment vehicle, a pool of private funds managed by a sophisticated manager for the sophisticated and wealthy investors. Due to their requirements and the structure, hedge funds, unlike other funds such as mutual funds or ETFs, are partially not regulated. In addition to that, hedge funds cannot seek funds from the general public. They operate on a private investment partnership. Therefore, they have more operational freedom and can aim to generate returns in any kind of market, regardless of the market condition. In general, hedge funds and mutual funds fall under the same category of pooled investments. However, they're differentiated by the distinguishing attributes of the investor's requirements. According to the SEC, an investor is considered accredited when they have earned an income of $200,000 in the last 2 years and expects the same in the current and the future year, or hold a net worth of more than $1 million. This is required to ensure that the investor is able to take on the risk of investing in these unregulated securities. Therefore, the investor needs to be conscious of the uncertainties of taking such risk, which in case of unexpected events could destroy their entire investment. Unlike the traditional mutual fund managers, the managers of hedge funds are more diverse in nature and have the technical know-how to use exotic or complex instruments like derivatives to generate returns. The ability to go long or short in an asset means they can make use of more complex strategies such as equity hedging, tactical trading, and arbitrage, where they take advantage of pricing inefficiencies in an asset, although this is not so common anymore, with there being fewer opportunities due to the rise of high-frequency trading and the overall competitiveness of the market. So basically, the managers have the skill to formulate their own trading strategies depending on the market conditions. Therefore, they can charge an extra incentive fee on top of the management fee for their performance. The annual management fee ranges from 1 to 2% independent of the performance of the fund. Additionally, the incentive fees typically range from 20% to a whopping 50%. This fee acts as an incentive for the manager to outperform and generate better returns in the market. There's been a lot of pressure on hedge fund managers to reduce their fees, and in fact this year we have seen a lot of capital being withdrawn from hedge funds, particularly in Asia, due to the excessive fees that they're charging and the availability of alternatives. This is also partly due to the relative underperformance of macro-related funds. This has led to a lot of money moving to private equity and real estate instead. Overall, there has been a big rise in the number of hedge funds, from a mere 610 in 1990 to a phenomenal amount of 15,000 in 2017. The funds that practice automation in their investment procedure have seen enormous growth in the hedge fund segment. Barclays claims that quants are now responsible for around 17% of the total hedge fund assets. This past decade has seen a sharp rise in the technological fields such as machine learning and artificial intelligence. In fact, a new kind of hedge fund is now combining machine intelligence to manage the investment of an American hedge fund. It's believed by some that the high usage of technology might prove to be helpful in preventing the market from large shocks in the future, as with time, AI, artificial intelligence, will eventually exceed human abilities and perhaps get closer to solving the stability puzzle. By nature, hedge fund managers tend to be secretive. Therefore, transparency remains a big issue when considering investing in hedge funds. The managers tend to be secret in their ways and the use of their strategies, and may even keep the funds under a lockup period, whereby investors can only take out their funds during specific intervals that are set by the manager. This overall issue was heightened by the infamous Ponzi scheme run by Bernie Madoff. Madoff took the money from investors and portrayed false returns to get away with it. This multi-billion-dollar scam affected many investors and charities, and Madoff was later sentenced to 150 years in prison for various charges. These events suggest that this level of secrecy might be wrong, and pressure from institutional investors has compelled some of the hedge fund managers to present their financial report on a regular basis. Hedge fund managers often use leverage to boost their returns and to make the fund more attractive. While leverage has of course got its benefits, it also has its downsides as it increases the volatility of the fund, thereby making it much more vulnerable to downside risks. This is illustrated in the case of long-term capital management, LTCM. LTCM was formed in 1994 and was highly publicised around the world due to the reputation of the founder and the board members, John Meriwether, the former vice chairman of bond trading at Salomon Brothers, and Myron Scholes and Robert Merton, who both won a Nobel Prize for their work on the valuation of derivatives, including their famous Black-Scholes options pricing model. LTCM generated an average annual return of 30% after fees up until 1997. Due to their reputation and popularity, LTCM was able to obtain extremely high leverage from large banks and was in a position to enter large swaps contracts. But soon, disaster struck. After the Russian crisis, LTCM was hit by a loss of more than $4 billion. Its loan to value had reached 250 to 1 at its peak leverage, and ultimately the US Federal Reserve had to come in and bail out LTCM, as this kind of event could have resulted in a complete financial meltdown. However, the blame for this does not solely fall with LTCM. It's also the fault of the banks that provided such ridiculous levels of leverage without fully assessing the risk in LTCM's strategy. Nevertheless, operating on such high levels of leverage is an invitation to a lot of trouble. Perhaps the most documented role of hedge funds was their involvement in the financial crisis. Now, although this is something that does warrant a whole series of videos of its own, let's just go over a very quick and brief overview. So in response to the recession of 2001, the US Federal Reserve lowered its rates down to 1.5%, which also meant there were low returns on bonds. Hence, the pension funds moved their investments into hedge funds to earn greater returns. This resulted in managers generating riskier investments, such as the mortgage-backed securities. These were a pool of mortgages which at the time were really profitable. Due to the huge demand for mortgage-backed securities, some of the larger institutions also started to form their own hedge funds. It was also at this time that the lowered interest rates resulted in large amounts of people opting for interest-only mortgages. Homeowners would take a home loan from the lender, who would then sell them on for a commission to investment banks. The investment banks bundled these mortgages along with other debt such as student loans, car loans and so on, and created something called a collateralized debt obligation, a CDO, and then passed it on to the investors, as it gave the investor a wide variety of choice in terms of risk. However, in order to tackle inflation, the US Federal Reserve increased their interest rates. As you can imagine, this resulted in more defaults by homeowners, and especially the subprime segment. The wake of 2007 saw many of the eminent hedge funds collapsing due to their high risk levels. And finally, when the housing bubble burst, this whole chain was jolted and the markets collapsed. Hedge funds managed to avoid a lot of the responsibility, since these risky investments were also being used by banks, insurance companies and other funds, and the hedge funds were not directly responsible for the formation of these destructive securities. However, they did actually hold the largest amount of CDOs at the start of the crisis, 47%, and it can be argued that the hedge funds gave the CDOs the impetus which ultimately led to part of the crisis. This suggests a stricter regulation of hedge funds should be put in place to avoid these kinds of events happening in future. Although there has been a lot of skepticism about investing in hedge funds, most of the criticism actually lies with their high fees and lack of transparency. However, there has been a gradual shift over time towards more transparency, better regulation and lower fees, and these issues are also expected to further improve in the future. Hedge funds are accessible to retail investors via funds of hedge funds, and statistically speaking, hedge funds have in general outperformed other asset classes while remaining relatively stable amidst various crises. The structure of hedge funds gives the hedge fund manager the freedom to invest in any market using any kind of investment, naturally giving them a wide variety of choices. Historically, hedge funds have proved to reduce volatility and provide diversity in an investor's overall portfolio. And with the advent of machine learning and AI, we may even see better stability in the future in one of the most complex systems in the world, the capital markets. If you like this video, please hit the thumbs up button and don't forget to subscribe for more financial education videos covering the markets, trading, investing, and much more. Thanks a lot for watching. See you soon.